when you can find mom and pop owners who will sell you their property with a lot of upside, a lot of meat left on the bone, then you can get, you can pay a high price. You can pay them more than they ever thought they would get. And I can give you an example here in a moment of a deal we just did. But you can pay the seller more than they ever thought they would get, but it's far, far less than you can make it worth by forcing appreciation.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called the Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below. All right. Hey, how's it going, everybody? So today we have Paul Moore on with us, and we're going to talk a little bit about his background for a second. So Paul did a stint at Ford Motor Company, and he co-founded a staffing firm where he was a finalist for the Michigan Entrepreneur of the Year 2 years in a row. After selling the firm to a publicly traded company, Paul began investing in real estate. He founded multiple investment and development companies, and he appeared on HGTV. Eventually, he built and co-managed a successful multifamily development. So Paul co-hosts 2 podcasts, including The Art of Investing and How to Lose Money. He's also a contributor to Fox Business and Bigger Pockets, producing live video and blog content on a weekly basis. Paul is the author of The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing and Storing Up Profits. Capitalize America's Obsession with Stuff by Investing in Self-Storage. Paul is the managing director of 3 commercial real estate funds at Wellings Capital. Paul, what a background. I'm really excited to have you on with us today. Thanks for joining us.
Yeah, it's great to be here, Mike. Thanks.
So, hey, Paul, I'm going to start this off the way I like to start all of my podcasts episodes, and I'm going to ask you a little bit about yourself and your background. So if you could share with our audience your story, tell us how did it all get started for you, Paul?
Yeah, when I went to college, I had no idea what I wanted to do, and I thought drilling oil wells sounded exciting and masculine, and I thought, I'll be an engineer, and that was my first mistake. And but thankfully, when I got out of college, oil prices had dipped to like $12 a barrel, I think, and so oil was in the tank, and so I decided, well, I better go out and get an MBA, which I did. Then I went to Ford, as you said. And while I was at Ford, I really liked Ford in Dearborn and Detroit, Michigan. But I always had this itch. I was spending evenings and weekends, kind of thinking, what could I do on the side? And I finally realized, maybe I should be an entrepreneur. Well, a friend of mine was a couple of years ahead of me in that. He had quit Ford after about a year there. He was the controller on the Ford Taurus project, amazingly, out of college. And he started this staffing company. So I joined him, opened up a Detroit area office, and we were off to the races, and sold that 5 years later to a publicly traded firm. And at just under 34 years old, I found myself with way more money than I had any sense. And I had no idea what it meant to be an investor. We moved to the Blue Ridge Mountains to raise our kids. We left Detroit in 1998. And I thought, I'm a full-time investor now. Well, the truth was I was a full-time speculator. And I did not know at all the difference between investing and speculating. Mike, investing is when your principal is generally protected and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And I was a speculator. And I was going in for those unicorn deals, thinking I was going to get, this was going to be the one to make me seriously rich. And, I lost a lot of money. I made some money as well. But that's one of the things that, 15, 18 years later led me to starting the podcast, How to Lose Money. But that was sort of my early years. I ended up in real estate in the year 2000. Flipped our first home in a town in Martinsville, Virginia, that had about 23% unemployment. And anyway, we were off to the races after that.
That's some way to get that whole party started, because you started off in an area completely different from where you are today, right? You wanted to be an engineer, right? An industrial engineer to drill some oil, and because that was the big thing to do. And it's unfortunate that you were getting yourself prepared for a career field that was literally tanking at the time. The
Right,
oil was in the tank, right? So,
right,
and you had to completely change everything that you were doing. It's a testament that you were very adaptable to be able to overcome, the situation that you were in. So switching over, getting the MBA, and then starting up the staffing firm, or joining up with your friend that started it up
right.
earlier. I'm pretty sure that that was taking you outside of your comfort zone,
Yeah, it was.
because that was not the route you were originally going.
Right.
So I have to ask though, when you were doing that staffing firm, you got yourself to a point where you were able to sell it to a publicly funded, a publicly traded company and make a lot of money out of it. I have to ask, well, I'm not going to ask what company it was, but you found yourself in a situation where you had a lot of money and you didn't know what to do with it. What made you decide to go into real estate?
Well, I piddled around for a couple years, and we were kind of expecting Y2K to be worse than it was. I had a friend. I didn't have a whole lot of direction. I was actually doing a nonprofit organization at the same time that I was actually pouring some money into, and had a friend who moved from a different state, very close friend. And he had years of experience in apartment maintenance. And we heard a rumor from a guy that you could actually buy houses for, let's say, 50 cents on the dollar on the courthouse steps that had been foreclosed. And so we thought, well, that would be fun. That's something you could do the work. Maybe I could put up the money. And so we went to the courthouse steps December 20th, 2000, on a snowy, icy day. We took no money at all. We had our wallets, we had no money. And we looked at a house that we had comped out. We didn't have enough information to really know, but we figured from the tax assessment and the neighboring houses that it was probably worth about 65,000. We went and peeked in the windows. It was vacant. And we said, gosh, this house looks like it's clean. The appliances are all there. There's nothing broken that we see. It looks pretty amazing. It looks like it's worth 65,000. Very little repairs, maybe a little paint in the kitchen and living room. And that was, it all turned out to be true, by the way. But we said, boy, if somebody gets this for under 50,000, they'll get a great deal. We didn't really know how the numbers should run. But we got to the courthouse steps, snow and ice, which they're not used to in Southern Virginia. And the ladies showed up for the auction. We were the only people there. We didn't think about the fact that there was 23% unemployment around there, but there was nobody else there. And she opened the bidding at about 32 or 33,000.
Oh,
And we
wow.
said, what? You've got to be kidding. And so we talked her into, and I've never seen this happen since. We talked her into going to lunch at Taco Bell while we rushed across town to get a $3,400 cashier's check from the bank, get back there and put the 10% down to bid 34,000. I think that's what it opened at. And so we got it, we bought it. 3 weeks later, we closed on it. And 3 weeks after that, we stuck a for sale by owner sign in the yard at 8:30 in the morning on a certain day. I think it was a Monday. And by noon, we had a full price offer. We sold it. And we thought, this is easy. We just made $5,000. We can do this all year long. We can do one or two a month at least, if not more. And then, of course, we lost money on 2 of the next 4 houses. And we realized it was harder than we thought. But that was how we got started.
Wow. So that first deal was the catalyst that got the whole thing started. That's really amazing. I mean, for your first deal to be something like that. And good job convincing her to go eat lunch while
I
you ran
know.
and go grab that cashier's check. That
Yeah.
you're pretty fortunate that you were able to do that. And thankfully, you two were the only ones there, so that made that kind of easy.
I know it was just a real blessing. I think that we made a large profit and it was super easy the first time because we were fishing for what we wanted to do. We were also thinking about opening a car lot, like a car dealership. And so I'm really glad that the first one went so well. It gave us so much encouragement to keep going.
You said the next two didn't work out so well, though. What happened with those?
You know what? The next one was in that same area that had huge unemployment and the margin of safety was much thinner. So we lost a little money on that. The time on the market just killed that next one. It turned out that the first one, there was a lady right down the street whose mom was looking for a house on that street to move to. And so that was just kind of a fluke thing that she happened to be right down the street looking for a house right then. But the market was terrible. We didn't think of that. The fourth house was the worst in some ways, and that was we fell in love with this Cape Cod, beautiful Cape Cod, and we kind of ignored that the neighborhood around it was pretty crummy. And we were like, this house is just so majestic. Everybody would see that. Everybody can see it's worth, I mean, if we could get it, on the market for, 80,000, I mean, who cares if the other houses in the neighborhood are 50 or 60? This house is beautiful and everybody should be able to see that. We completely misunderstood that the nature of comps and how the comparable houses drive the residential, and I want to say clearly the residential market. Commercial is quite different. And maybe we can talk about that later, Mike, but residential is driven by comps. And so after a long, long time holding out to get, whatever price, we finally dropped it to like 65,000 and sold it at a loss. And that was a painful, but a very good lesson for us.
Yeah, there's that saying that they always say too. It's having the nicest house in a
Yep.
crappy neighborhood uh,
Yep.
isn't necessarily a good thing, right?
That's right.
So, okay, awesome. So, actually, I do want to talk about commercial real estate, but there's also something else I want to talk to you about. I know you have a rags to riches story, right?
Uh,
And I want to talk about that a little bit because a lot of times people find themselves overwhelming with debt and they
yeah.
don't know what to do. They don't know how to get out of it. And a lot of times people find themselves lost. And one of the
Yeah.
things that we like to talk about here, especially is stories like that, is folks that were in a lot of debt and were able to overcome it, and not only overcome it, but beat it completely because now they're investing and they're doing other things where debt's not necessarily the enemy. So I think you have a pretty good story that I'd like to share with our audience on that. So can we talk about that a little bit?
Yeah. It's sort of a riches to rags and backstory. What happened is I had almost $2 million in the bank after I sold my company in 1997. Exactly 10 years later to the month, I had $2.5 million in debt. And it wasn't the story that it was supposed to be. And that was hinging a lot on my speculative nature. I lost some money on some things. I was making really good money flipping waterfront lots at a resort lake in the 2004 to 2007 range. But the market for waterfront lots ground to a halt. We had all these lots. And then my business partner came to me and said, dude, I can't do this anymore. This was about November of 2007. He said, I can't keep making half of this interest payment. Look, I'm just going to turn all these lots and also not only the lots, but also the debt over to you. I'm walking. And so I understood that, and we're still good friends today. But it was painful, and that left me with $2.5 million in debt. Now that counted my house, my lakefront house, and then a whole bunch of these waterfront lots. It included an albatross, which was an $800,000 or so 5-acre waterfront lot that I thought in my speculative thinking that I could split into 5 1-acre lots. And we could sell each one for about 400,000. And so we'd have, maybe almost a $2 million gross revenue situation on our hands with 800,000 in debt. Well, turned out that the county and the state of Virginia had not authorized me to split that into 5 1-acre lots. And I just presumed I could swing it anyway. So we went into December of 2007 thinking, hopefully the worst of this crisis is over. Of course, you're real familiar and you know, and I know that the worst by far was just in front of us, but we couldn't see that at the time. It's really important to put yourself where we were then, thinking, hopefully the worst of this is over. Hopefully I'll sell my house in Waynesboro, Virginia. You're thinking, I'm thinking, hopefully, this everything's going to be fine in January. Well, obviously 2008 was much, much worse. And 2009 technically might have even been a little worse. Anyway, I was sitting in my chair. I try to do a morning meditation time and journaling and stuff like that. I was sitting there one day and I thought, this really strong impression came to me. What would George Mueller do? Now, George Mueller was a guy, is also known as George Muller. He was a German hellion in the early 1800s, and he lived this, this awful life. And then he became radically transformed, and then he moved to England and became a pastor. And he actually started teaching people to manage their money. He was trying to teach men in particular to manage their time. And the people in his church were like, I'm too busy. Pastor, you've got it easy. You just live off these offerings, but I got to go out and work 2 or 3 jobs. I don't have time for my family. I don't have time for church. I am just going to stay focused on this. And so he decided, I'm going to show the world that it's possible to not have to work, 90 hours a week or whatever. It's possible to be different. So he actually began taking care of orphans. He and his wife started caring for orphans, and they took meticulous records of their entire career, like the next 70 years, I think. They kept incredibly meticulous records of every dollar they made and every dollar, English pounds, that they spent. And they took in, through no fundraising, no marketing. In fact, they were anti-fundraising, anti-marketing mindset. They took in between a quarter and some people say $500 million in today's US dollars in funds. And they did it all based on radical generosity and faith and all these things that, were just not common at the time. So I had read his biography and I thought, what would George Mueller do right now? Well, first of all, he'd be a little more like Dave Ramsey, probably. He wouldn't be in debt at all. And so I'm already strike one against me. But I thought, if he was in debt, $2.5 million, what would he do? I think he would start giving radically. So I told my friends who said, hey, what are you going to do? Declare bankruptcy? I said, no, I'm going to give my way out of debt. And they looked at me like I was crazy. And then I went and told my wife and kids, I said, hey, gather around. We're going to give our way out of debt. And they're just like, oh, I don't know. They were little kids, And so I said, guys, we're going to have a family. We're going to have a story that's going to last for decades to come. And you can tell your kids and grandkids what happens here. I don't actually know what's going to happen, but something will happen. And so we started giving a set amount every week, starting January 1st, 2008. We'd already been giving, but now we were really determined. We have this set amount, and we gave that amount every week, week in, week out. The 4th week into this, the end of January 2008, I met a real estate developer, and I could tell you a long story about this, but the summary of it is, I was talking to him at a Subway restaurant. I told him my plight, and he said, you ought to try this. And this led to a light bulb moment. 2 days later, I was at the County Planning and Zoning Commission, and I laid out this outrageous plan to circumvent their law, but using the law to circumvent it by saying, I can subdivide these 5 acres into 5 1-acre lots, and here's how. And the lady looked up at me and shook her head, and she was just like, you've got to be kidding. She's like, I've worked in this department for like 30 years. She said, no one has ever presented us with such an outrageous way to circumvent our law. And then she smiled and she said, but you did. You're right. You found a loophole in the law no one has ever found. And she said, you're right. I can't stop you. In fact, I will approve your permit to subdivide these 5 lots.
Wow.
Well, now we're going into summer and then fall, spring, summer, and fall of 2008, which the real estate market was going like this in general. How much worse was it going for waterfront houses? And how much worse was it going for waterfront lots? Well, you know what, Mike? I sold 4 of those 5 lots for a huge profit right in August and September of 2008, in the worst months of panic in the whole situation. We were selling those lots like crazy. And I found myself, it was hard work, a lot of risk, a lot of sweat and effort, but 13 months later, I was completely debt free.
Let's take a quick break from today's episode to hear from our show sponsors. Hey everybody, how's it going? This is Mike Cav with Average Joe Finances. You know, we're living in some pretty tough times right now, and if you don't have life insurance, you should probably get it. You need to protect yourself, protect your family, and protect what you own. Check out the link below in the show notes or in the video description. Hey, what's going on everybody? It's Mike Cav from Average Joe Finances. Just want to talk to you today about Prep Agent. If you're interested in learning how to become a real estate agent and being able to pass the test on your first try, check out Prep Agent. Check out the link below in the show notes or in the video description. Welcome back, everybody. Let's get back into it. How the heck did you sell those during that time frame?
Well, I haven't actually shared this detail very often on podcasts, but I'll tell you, I realized that, see, this whole area is rural, and the Smith Mountain Lake in Virginia, which is where What About Bob was filmed, by the way, not Lake Winnipesaukee. And this rural area all has well and septic. I realized that the houses who had 8-bedroom septic systems, as opposed to the standard 3 or 4 bedroom septic, I realized they rented for about double the price that others rented for. So I pitched this as a little rental community. In other words, I said to people, look, you can get an 8-bedroom house on this lot where usually you can get 3 or 4, and nobody was thinking this way. And I even wrote a book on this, on Smith Mountain Lake real estate, which is still being sold today in its 3rd edition. And I had a chapter in there about how to make an 8-bedroom septic and then use that to get a much, much higher value house. And so I convinced 4 people to buy these, and eventually 5, then the last one was 2009, people to buy these 8-bedroom septic lots that I had set up. And then they did. And actually, the irony of it all is only 2 of those 5 houses actually ever were rented. The rest people went and moved into permanently. But anyway, that was how it happened.
Wow, that is fantastic. Well done. Yeah, so I think this is a good segue into the next thing I wanted to talk to you about, because it sounds like this might have started scratching the itch more in real estate for you. And what got you started into multifamily real estate?
Well, 2008 was, I described this glorious time in 2008 and 9, but I was hurting personally through a lot of that. And so I finally, just like I did as an engineer 20 years before, that's about right. I realized I needed to branch out. So I actually got trained in copywriting. And through that, I ended up in an oil and gas deal. I know it sounds crazy, in North Dakota. And a bunch of my friends and I went back in and we invested a lot of money, a total of about $1 million, although my part personally was only a fraction of that, into this oil and gas deal in North Dakota. Now, my friend had a small jet, and he would fly back and forth to check out this oil and gas investment in this North Dakota boom area called the Bakken oil fields. And he found that there was no place to stay. In fact, the $89 Holiday Inn and hotels, the few that were there in this really remote area, were charging like $300 or $400 a night and staying full. And so he said, look at this, oil's expensive. There's a massive number of job openings, 18,000 job openings in this area, because they have no housing. People are sleeping, especially men, were sleeping in their cabs of their trucks or their pickups or their RVs or whatever, all along, Walmart parking lots, and every area, like the rest stops and everything were just full of people, and they need housing. But the land is dirt cheap still, especially land where the oil rights, the mineral rights, have already been sold off. So we bought, I think it was 75 acres, and we very quickly put 2 multifamily housing developments on there. And we were able to, and this is crazy, and I told Brandon Turner this, And it was crazy when I said it, but the average price per square foot of multifamily, not in Hawaii, but around the rest of the country, is, roughly $1 a square foot a month. So a 900 square foot apartment might, a B or C class might rent for $900 a month. Well, we were renting for $13 a square foot. We were renting for $4,000 a month and for a 300 square foot efficiency. Now, it was fully furnished and it had all the utilities and internet and everything, but we were making bank. And that's how I first got involved in multifamily. I'll tell you, my friend, my business partner, actually went on to build a Hyatt hotel and I helped him with it, but it was all his. And it actually went really, really badly. And so I decided, I think I want to stay in multifamily. And so I actually went and got a mentor, learned everything I could about multifamily, all kinds of things I didn't know when I was running that myself. And actually, that's what launched me into the multifamily realm. And then I was so excited when I learned about the magic of commercial real estate compared to residential.
Yeah. So, and part of that magic, is how you can also force appreciation, right? So I'm pretty sure that's one of
Exactly.
the biggest discoveries that just blew your mind, because that
Mm.
it blew my mind when I started learning about that, and that's why I want to start looking into commercial multifamily myself. That's fantastic. You've kind of been all over the place with real estate, like touching almost every single facet, right? Because even after multifamily, so there's more to that, isn't there? I know that there's a lot of multifamily investors that are now turning to self-storage and also mobile home parks and getting
Mhm.
huge returns. As a matter of fact, because you brought up Brendan Turner, so he's one of them, right? He is huge into mobile home park investing. So why do you think that's happening right now?
Yeah, so I wrote a book in 2016 called The Perfect Investment, as you mentioned earlier. But then around 2017, I said, I've been beating my head up against the wall for like 3 years now. And it turned out to be a long time after that as well, where I said, the perfect investment is no longer perfect if it's overpriced and you have to pay more than it's worth to get it. And so we came to the conclusion that the consolidation and the popularity in the multifamily realm was so high. It was very, very hard to get a good deal. And there's so many reasons I could dive into for this, but I'll just summarize and say multifamily was overheated for the most part. And there are people out there who have these wonderful acquisition teams that can sniff out these great deals, that nobody else finds. We didn't have that. Our team did not have that acquisition specialty. And we honestly didn't have the track record and the team and the experience. I mean, and so we decided that we probably would be better off expanding into another realm. And so we started looking at self storage and then mobile home parks. And we realized some really, really critical factor. And that is when you can find mom and pop owners who will sell you their property with a lot of upside, a lot of meat left on the bone, then you can get, you can pay a high price. You can pay them more than they ever thought they would get. And I can give you an example here in a moment of a deal we just did. But you can pay the seller more than they ever thought they would get, but it's far, far less than you can make it worth by forcing appreciation. And it's hard to force appreciation in multifamily right now because most of the value add, most of the heavy lifting's been done because they're so popular. But self storage, mobile home parks, very different. Self storage, roughly 50% of the self storage in the country is owned by mom and pop owners who don't have the desire or the resources or the knowledge to improve it and do those value adds to maximize the dollars. Look, they're sitting pretty. They've owned this place maybe for years. Maybe their debt is low or debt free, and they're doing fine. 85 to 90% of mobile home parks, there's about 44,000 in the country, are owned by mom and pops. And so they have definite shortcomings as far as their ability or their desire to improve the value of these properties. But the value formula in commercial real estate and the forced appreciation nature of it allow you to take a mom and pop and potentially double its value in even as little as a year And then using leverage, that doubling the value with 50% leverage means that you're quadrupling the equity. In other words, an investor in a year might see a 4 times return. And by the way, that's not the norm. I'm saying there are deals like that, and I can prove it. But and I mean, even if you could get a 50% increase in your equity over 3 years, I mean, think about that. That's what, 17 or so percent per year. That's pretty amazing.
Yeah, I know for a fact that's true. As a matter of fact, I had a guest on the show. His episode aired a couple weeks ago, and he was talking about how his first commercial real estate deal was self-storage, and
Yeah.
he quadrupled his money instantly
I
from
believe it.
what he paid for it to what he sold it for because of forced appreciation. And that's just
Yes.
amazing. So, and you said you wrote a book on it. What was the name of that book again?
The new book on self storage is called Storing Up Profits:
Okay.
Capitalize on America's Obsession with Stuff by Investing in Self Storage. And that is supposed to come out in the spring or summer of 2021 from Bigger Pockets Publishing.
Fantastic. Well, I'm looking forward to that coming out. That's going to be amazing. I want to ask you though about your podcast, right? The ones that you co-host on. One of them is called How to Lose Money. So why do you have a podcast called How to Lose Money? Isn't that the opposite of what we're all trying to do?
Why would that seem unusual? No, I'm just kidding. You know, I tell you, Mike, years ago, I would sit in the audience, and I remember this one conference I went to, and all the people were sitting at a round table, and they would compare, they would talk after the between speakers, and we'd have these breakout sessions. And these speakers would get up one after another and talk about their triumphs, all their successes, all their great deals. And honestly, people would sit around the circle and they would just be slumped over like, oh, I'll never have those advantages. That guy had the right pedigree, the right parents, the right job, the right, you know, connections, the right education. All the things worked out for them, but never does for me. And you know what? I thought there's something very, very wrong here. These people are actually being discouraged from doing the very thing they came to the conference to learn. And so I thought if I ever got on a stage, I would want to tell a different story. Well, I found out when I actually met some of those people and got to know them, I realized they had the same struggles, the same pain, the same insecurities, and the same losses as everybody else along the path, but they didn't tell that story. And so when I actually started a podcast in 2016, we decided we were going to call it How to Lose Money. And so we interview people who are great, successful investors. We interview them about their pain and their losses and their agony on the way to the top. And we've interviewed about 238 people, and it's been a wild ride.
That's awesome because that is like the complete opposite of what people talk about when they go on these different kinds of podcasts. Like, we talked a little bit about that, but we're more focused right now, on your story about your successes. Yeah, we've talked about some of the losses in there, but that's a really good way to get that out to people that might find themselves down and out. So I definitely encourage our listeners to go check out that podcast. That sounds like it's going to be very enlightening for some people. It's looking at a side of the spectrum that a lot of people don't really think about. And and for a while myself as well. And that is, what happens when you're down and out, when you've lost money and you have a failure, right? Well, you see the people that are successful, they've turned that failure into success.
Mhm.
And it's something that everybody can do. You take your lickings and you move on. You got to learn your lesson and move on. Don't keep doing the same thing over and over again, right?
Yeah.
Because I mean, that's what Einstein said the definition of insanity is, right? So
Mhm.
doing the same thing over and over again with no change in results. And that's obviously not going to happen. You're not going to get a change in results if you don't change what you're doing and change your own mindset, right? That's something I
Yeah.
had to do in my own personal journey myself. When I was swimming in debt, I had to change my mindset to move on and get out of there. Really fantastic. This has been great. You have done amazing things from your start bouncing around. But I want to point out one thing though. You wound up back in gas and oil. Like, how did that happen? You started off there 20 years ago, and then, well, more, from the point when you went back into it, and then you you got back into it when you did that deal up in North Dakota, right? So
Yeah, it was complete speculation. We were
yeah,
counting on, putting, let's say $1 million into an oil well and, sending up $100 million in profits. And we had all kinds, geological data, everything to prove it would work. And the speculation cost us dearly. We put a total between my friends and I $1 million down the hole and came up with exactly zero. So, yep, don't plan to do that again.
so that's actually a very big thing I want to talk about real quick. Speculating, right? So it sounds like you've done a lot of that throughout your career. So can you
Yeah.
explain to our listeners the difference between speculating and actually investing?
Absolutely. So, like I said earlier, investing is when your principal is generally safe and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. Now, it's said that true wealth is owning assets that provide cash flow. And if that's true, you can see why true wealth would be accumulating investments. In other words, assets that produce income. Speculating, on the other hand, is not an asset that produces an income. It is generally uh, bidding on or buying, investing in an asset that will go up and down based on the mood on Wall Street or a CEO scandal or success or a war in the Middle East or just fear and uncertainty. We've got a lot of fear and uncertainty in our economy right now, and things like Bitcoin have just climbed through the roof. But Bitcoin is not an asset that produces income. It's, the reason it could go from 29,000 to 41,000 in 10 days is the same thing that could cause it to go from 41,000 back to 29 or even 9 next month. And so I'm not criticizing Bitcoin either. I'm just saying if you want to speculate in gold, silver, oil, and gas, go ahead. It's fine as long as you realize you're speculating and you have the ability to, you're willing to take the risk that you could actually lose that money.
Yeah, I think that goes pretty much with any investment. All investments have some type of inherent risk to them,
Right.
right? But you're taking a much bigger risk when you're speculating versus
Right.
investing. At
Right.
least, if you go buy an investment property and you've got tenants and you're having a cash flow income, yes, you have risk. Like, I mean, look at what happened this past year with this pandemic. A lot
Right.
of folks started losing their jobs, and when that happened, rental income started going away. So a lot of folks that
Mhm.
had these properties started losing their income. So again, it doesn't go without risk. Now, there's many different programs out there to help out, both sides of the aisle here. I know I even helped one of my tenants get picked up for a program, and they were able to pay me the rent that he owed me. There's different things. You have to look. The big difference was, this was an investment property, and yeah, there was some risk there, but I still wound up getting what I was supposed to get. Yeah. So fantastic stuff, Paul. Really enjoyed this conversation. I would like for my listeners to know a little bit more about you. So where can they find information about you? Do you have a website, any social media profiles you can share with us?
Yeah, I mean, they can find me on Bigger Pockets, just put in my name and some of the blog articles. And then I do a live show on Bigger Pockets most Saturdays at 11 a.m. Eastern. But the best place to find me is at my company website. We have funds that manage self storage and mobile home park investments, and we allocate investor money across, at this time, I think 76 different assets that we're tracking. And we, like I said, we just sold some. The website is wellingscapital.com. That's WELLINGS, Wellings Capital, CAPITAL.com.
Awesome. We'll make sure we get that in the show notes so it's easy for everybody. They could just click it and go, or copy and paste it and go. Same thing for any social media profiles that you've shared with me. I'll make sure I get those in there, and a link to your podcast, because it sounds like it's amazing, and I can't wait to subscribe to it myself and listen to all your episodes, because I'm pretty excited about it. Oh, and to top it off, just because I want to bring it up because of the fact that you have these funds on your website that investors can invest into, that right there, for my listeners, that is passive income. So you're investing into something, it's going across the different assets that they have, and you're getting your return on your investment. That is for a new investor, that's a pretty good deal because that's a completely passive way to get an income.
That's awesome. Yeah, thank you very much. Yeah, we love our funds, and I mean, I'm investing heavily myself in my own funds, and I don't know a better place, to have to get cash flow and appreciation except in self storage and mobile home parks, like we talked about.
Yeah, that's fantastic. Looking forward to that book coming out in 2021. So all my listeners too, make sure you're on the lookout for that. Paul, it was an absolute pleasure having you on today. Thanks for joining us.
Great. Thanks for having me on here. It was a real honor.